Imagine walking into your local bank and asking the manager one simple question. How much money do you actually have in this building? What do you think the answer would be? Most people imagine enormous underground vaults packed with billions of dollars in cash. Movies have taught us that banks are giant warehouses of money, protected by thick steel doors and surrounded by armed security. But here's something that might surprise you. If everyone who had money in that bank showed up tomorrow morning and asked to withdraw every dollar at the exact same time, the bank wouldn't be able to hand everyone their money immediately. That sounds impossible, maybe even frightening. But it's completely normal. And it isn't because banks secretly lost everyone's money. It's because the biggest misconception about banks is believing their job is to store cash. It isn't. Their real business is making money from money. Once you understand how that works, you'll realize why banks have become some of the richest businesses on earth. Let's start with the biggest myth. When you receive your paycheck and deposit it into your bank account, you probably imagine your money sitting safely inside, a vault with your name attached to it. It feels logical. After all, it's your money. But banks don't separate every customer's cash into individual piles. Instead, your deposit joins millions of other deposits. Think of it like pouring a bottle of water into a giant lake. Once it's there, it's part of something much bigger. The bank knows you probably won't need every dollar tomorrow. At the same time, millions of other customers are also leaving money in their accounts. Because of that, banks can use a portion of those deposits to provide loans to other customers. Someone wants to buy their first house. Someone else needs a loan to start a restaurant. A family wants to purchase a new car. A company wants to build another factory. The bank lends money to all of them. But here's the important part. The bank doesn't lend money for free. It charges interest. Imagine you borrow $100,000 to buy a house. Over many years, you'll pay back much more than $100,000. That extra money is one of the biggest reasons banks earn billions every year. Now here's where things become even more fascinating. Imagine you deposit $1,000. The bank uses part of that money to make a loan. The person who receives the loan spends it buying a car. The dealership deposits that payment into another bank. Now that second bank also has new deposits that it can use to support more lending. The cycle continues over and over again. Money keeps flowing through the economy instead of remaining locked inside one building. That's one of the reasons banks are so important. Without banks, it would be much harder for families to buy homes, students to attend college, entrepreneurs to launch businesses, or companies to grow. Banks help move money to places where it can be used. But loans aren't the only reason banks make so much money. In fact, many people pay banks without even noticing. Think about all the different fees you've seen. Monthly maintenance fees, ATM fees, credit card interest, late payment fees, wire transfer fees, foreign transaction fees, business account fees, investment management fees. Individually, those charges seem small. Maybe $3, $5, $10. But now imagine millions of people paying those same fees every single day. Those tiny amounts add up incredibly fast. A few dollars multiplied by millions of customers becomes billions of dollars every year. And that's only one part of their business. Banks also offer mortgages, business loans, investment services, retirement accounts, wealth management, insurance products, and financial advice. Every one of those services generates revenue. Now you may wonder something else. If banks are making so much money, why do they still encourage people to open savings accounts? Wouldn't it be easier if customers simply spent all their money? Actually, no. Banks love deposits. The more deposits they have, the more financial activity they can support. Deposits allow banks to provide loans and offer additional financial services while following banking regulations. In other words, your savings help power the banking system. Here's another fact that surprises many people. When you hear that a large bank has $2 trillion in assets, most people imagine $2 trillion sitting inside giant vaults. That's not what it means. Assets include mortgages, business loans, credit card balances, commercial real estate loans, investments, and many other financial products that generate income over time. Those assets represent value. They aren't stacks of cash waiting inside a basement. Hollywood has given us the image of banks protecting mountains of money. Reality is much more interesting. Banks don't become wealthy because they keep money locked away. They become wealthy because they keep money moving. Now here's something almost nobody talks about. Banks make money whether the economy is booming or slowing down. During strong economies, More people borrow money to buy homes, cars, and businesses. During weaker economies, banks often continue earning income from existing loans, financial services, and many of the products they've already issued. That steady flow of income is one reason banks have remained powerful for centuries. But there's another secret. Banks understand something that wealthy investors also understand. Money loses opportunities when it stays idle. Imagine you hide $10,000 under your mattress for 20 years. At the end of those 20 years, you'll still have $10,000. But because prices generally rise over time, that money will often buy less than it could before. Now imagine that same money had been invested wisely over many years. Instead of staying the same, it might have grown significantly. Banks understand this principle better than almost anyone. Their goal isn't simply to hold money. Their goal is to put money to productive use. That doesn't mean people shouldn't save. An emergency fund is essential. Unexpected expenses happen to everyone. Having cash available provides financial security. But banks know that long-term wealth usually comes from making money work instead of leaving it completely inactive. Perhaps that's the biggest lesson hidden behind the banking industry. Banks don't think like savers. They think like managers of capital. Every dollar has a job. Every dollar should produce value. Every dollar should generate another opportunity. That's exactly how many successful businesses think. And it's also how many wealthy investors think. So why do banks have so much money? It's not because they own gigantic vaults filled with endless cash. It's not because they print money. And it's not because they're simply holding everyone else's savings. Banks have enormous wealth because they operate one of the most efficient financial systems ever created. They lend money. They earn interest. They provide financial services. They collect fees. They finance businesses. They manage investments. They help economies grow. And every single day, billions of dollars move through that system. The next time you walk into a bank, don't imagine a giant room filled with cash. Instead, imagine one of the world's most powerful money-making machines. Because that's what a modern bank really is. And maybe the most important lesson isn't learning how banks became rich. Maybe it's realizing that wealth is rarely built by letting money sit still. The people and businesses that build lasting wealth understand one simple idea. Money is most powerful when it's working. If you enjoyed this video and want to learn more about how money, investing, and wealth really work, make sure to subscribe. Because the more you understand money, the better your chances of making it work for you instead of working for it.